Welcome back to Smart Stock Sam, the channel where we cut through the noise and give you the raw, unfiltered truth about the stocks that actually matter. I'm Sam, and today we are talking about a company that has locked in an $800 million contract pipeline, attracted BlackRock and Vanguard as institutional backers, and is building technology at the bleeding edge of AI and real-world asset tokenization. And yet, the stock is trading for less than the price of a candy bar. I'm talking about Datavault AI, ticker symbol DVLT, and I am telling you right now, do not put a single dollar into this stock unless you watch this video all the way to the end. We are breaking down their Q1 2026 earnings in full, and what we found is going to shock you. This is Smart Stock Sam, and let's get into it. So here is the paradox that defines everything about this company right now. On one hand, Datavault AI has just secured an $800 million tokenization pipeline and reiterated a $200 million revenue target for the full year of 2026. That is the kind of number that makes institutional money sit up and pay attention. But on the other hand, they just reported a $53.1 million net loss for a single quarter. One quarter. 90 days, over $50 million gone, and if that wasn't enough to get your heart racing, the stock has been trading under $1, which has triggered an imminent NASDAQ delisting deadline, August 24th, 2026. That's just a few months away. They have to get that price back above $1, or they lose their listing on one of the most prestigious stock exchanges in the world. So you tell me, is this a company on the verge of a historic breakthrough or one stumbling toward a very public collapse? That is exactly what we are going to find out. Let's start with the numbers that everyone is talking about first, the top-line growth, because if you only looked at the headline revenue figure, you would think DVLT was the hottest stock in the entire market right now. Revenue surged by 443% year over year, landing at $3.42 million. 443%. Let that sink in for a moment. That kind of growth doesn't happen by accident. That is a company that is moving fast, capturing market share, and executing on a vision. But here is where the story gets complicated, and this is the hidden metric that most retail investors completely miss. When you look at the gross profit, it stayed almost completely flat at just $100,000. $100,000 of gross profit on $3.42 million in revenue. Do the math, and what you get is a gross margin of just 3%, and that is after collapsing from 11% the year before. What that means in plain English is this. For every single dollar of revenue they are bringing in, they are keeping almost nothing after paying the direct costs of delivering that revenue. Meanwhile, that net loss didn't just nudge upward, it ballooned from $9.5 million to over $53 million in a single year. So the question everyone should be asking is, how does a company grow revenue by 443% and still end up losing more money than ever before? The answer comes down to one strategic decision: growth through acquisition. This quarter's massive revenue surge was primarily driven by the takeover of CompuSystems Inc., known as CSI. And while CSI brought in significant revenue volume, it also brought with it lower margin revenue streams that effectively dragged the entire company's margin profile into the ground. But there is another layer to this that you cannot ignore. Despite that staggering triple-digit revenue growth, DVLT actually missed Wall Street's revenue estimates of $20 million, and they missed it by a wide margin, landing at just $3.42 million. That is a significant gap. It tells us that while the acquisition strategy is producing raw revenue growth, the company has not yet figured out how to scale that growth efficiently. They are buying the top line, but the bottom line is paying a brutal price. And that disconnect between revenue optics and actual profitability is the central tension at the heart of this entire story. Now let's look at where all the money is actually going, because the expense breakdown is genuinely eye-opening. General and administrative costs, your basic overhead, the keep the lights on money, multiplied from $5.6 million all the way up to $18.7 million in a single quarter. Research and development spending doubled. Sales and marketing costs more than quadrupled. When you look at that collectively, what you are seeing is a company in full blitz mode. They are hiring aggressively. They are building infrastructure. They are spending on sales like their survival depends on it. And honestly, it might. But here is the fundamental problem with this strategy. When your expenses are growing significantly faster than your revenue, you are essentially borrowing from the future to survive the present. You are making a massive bet that the growth you are buying today will eventually generate the returns you need to justify the spend. And for DVLT right now, that bet is enormous. So let's talk about what is actually working in their favor, because there are real tailwinds here that you cannot dismiss. That $800 million pipeline is not just marketing fluff. Those are signed contracts for real-world asset tokenization, a technology that is genuinely reshaping how we think about ownership, liquidity, and financial infrastructure. They have also launched a quantum-ready GPU edge network across New York and Philadelphia, positioning the company at the intersection of artificial intelligence and high-performance computing. That is a forward-looking infrastructure play that institutions are paying serious attention to. But the headwinds are fierce and they are real. Beyond the margin collapse, DVLT carries heavy exposure to Bitcoin. In Q1 alone, they took a $16.1 million fair value loss because of crypto market volatility. Think about that. $16 million gone, not because of anything the business did wrong operationally, but simply because Bitcoin prices moved in the wrong direction. You have a tech company that is essentially also acting like a crypto hedge fund, and that dual risk profile is going to keep a lot of conservative institutional capital on the sidelines, regardless of how strong the core business fundamentals look. That brings us to the balance sheet, which is where the real anxiety lives, and frankly, where the most pressing danger signs are hiding in plain sight. As of March 31st, Datavault had roughly $106 million in current assets. But here is the composition that should make every investor pause. $57 million of that, more than half, is in Bitcoin. Their actual cash on hand was just $2.2 million. $2.2 million. For a company burning through more than $50 million per quarter, that is a dangerously thin cushion. Now, since the quarter ended, they did execute a $60 million direct offering that brought their working capital up to approximately $140 million, which provides some breathing room. They also paid off a $10 million convertible note, which improves the debt picture. But that payoff came with nearly $2 million in extinguishment expenses just to close out the paperwork, which tells you something important about the cost of the kind of financing they've been relying on to keep this machine running. And that leads directly into the question of Runway. How long can they actually sustain this burn rate before the well runs dry? The company is currently reporting over $250 million in available funding, including a major contribution from their partner Silex. On paper, that gives them enough capital to complete their near-term infrastructure rollouts and keep the lights on. But the math is unforgiving. Their burn rate is so severe that the $200 million revenue target for 2026 is not aspirational. It is existential. If that revenue does not start converting to actual cash in the bank, and converting fast, they will be forced back to the capital markets for additional funding. And every time they go back to raise more capital, they dilute existing shareholders further, which is precisely what is suppressing the stock price right now, and precisely what retail investors holding this stock are most afraid of. Here is where the story takes a genuinely fascinating turn. We are seeing one of the most striking ownership divergences in the entire microcap space right now. On one side, major institutions are actively accumulating this stock. There are over 102 institutional owners in DVLT, including names like BlackRock and Vanguard. And Vanguard didn't just dip a toe in, they increased their position by over 900% recently. 900%. When the largest asset manager in the world is buying more of your stock, you have to take notice. They clearly see the long-term tokenization thesis, and they are positioning accordingly. But on the other side of that equation, insiders are selling. Silex offloaded 31 million shares. The CEO, Nathaniel Bradley, and the CFO have also been reducing their positions. Normally, insider selling is one of the clearest run-for-the-hills signals in the market. But here is the nuance that changes the calculus slightly. CEO Bradley also just acquired 2.59 million incentive shares that vest through 2029. That tells you he is not abandoning the ship. He is taking some short-term profits, but his long-term compensation is still directly tied to the company's success. Whether that is reassuring or not depends entirely on whether you believe in the execution story. So what are the actual catalysts that could flip this narrative? There are three that matter most right now. First, the M&A ecosystem they are building, integrating CyberCatch and the planned merger with NYIX to create a dominant digital asset exchange platform. If those integrations go smoothly, the combined entity becomes significantly more valuable than the sum of its parts. Second, and arguably most important for the entire industry, is the Clarity Act. If this legislation passes, it provides the regulatory green light that the real-world asset tokenization industry has been waiting for, and that is a tailwind so powerful it could lift the entire sector. For a company like DVLT that is already positioned at the center of that industry, the Clarity Act passing could be the single most important external catalyst imaginable. Third is the sentiment gap that currently exists between retail enthusiasm and professional caution. Retail investors are extremely bullish on DVLT. The professional analyst community is more measured, largely because of dilution concerns. But if even one of these catalysts lands, that gap could close fast. Now let's look at the technical picture, because the charts are telling a story that every trader needs to hear before they touch this name. Right now, the technical indicators are broadly bearish. The RSI is sitting at 41, neutral to bearish territory. The MACD is generating a clear sell signal. The stock is trading below its 5-day, 50-day, and 200-day moving averages simultaneously. That kind of bearish alignment across multiple timeframes is very difficult to break without a significant news catalyst. But here is the thing that should be on every trader's radar. The short interest stands at 13.6% with less than 2 days to cover. That means if a major positive catalyst hits, and I mean a real one, a big one, the short sellers will be forced to cover their positions rapidly, and that buying pressure could send the price vertical in a very short period of time. It is a classic short squeeze setup, sitting underneath all that bearish pressure, waiting for the right spark. For the week of May 18th through 22nd, here is your actionable setup if you are considering a trade. The current entry zone is between 50 and 51 cents. You have immediate resistance sitting at 52 cents, but the real resistance wall is at 55 cents. That is where the key moving averages converge. On the downside, initial support holds at 50 cents, but the critical floor, the must-hold level, is 47 cents. If the stock breaks below 47 cents and stays there, there is very little technical support beneath it. Compare all of that to the Maxim Group's analyst price target of $3 per share, and you start to understand why some investors are willing to stomach this level of risk. That is a massive theoretical upside, but it comes with heavy dilution caveats that cannot be ignored. Now, before I give you my final verdict, I have to be transparent with you, because that is what Smart Stock Sam is about. Nothing I say in this video is financial advice. I am not a licensed financial advisor. The analysis I present here is for educational and informational purposes only. Every investment carries risk, and microcap stocks like DVLT carry extreme risk. You could lose everything you put in. Always do your own due diligence. Consult a qualified financial professional before making any investment decision, and never invest more than you can afford to lose completely. The stock market is not a casino, but stocks like this one can feel that way. Be careful. Here is my honest read on Datavault AI based on everything we have covered. In the short term, the risk-reward here is genuinely unfavorable for most investors. The technicals are weak. Insider selling is a real red flag, and the cash position is dangerously thin. If you are a short-term trader, use very strict stop losses and respect that 47-cent floor. If it breaks, and you need to be out. But in the long term, if, and this is a very big if, they execute on the pipeline, this is an 87% undervalued story with a theoretical fair value of around $4.20. That is the math if the $800 million pipeline converts to real cash. And the make-or-break moment is coming in the second half of 2026. The company needs to recognize $100 million in fees from those tokenization contracts. If that happens, the capital structure stabilizes, the delisting threat evaporates, and the pipeline thesis gets validated. The stock probably goes on a run that early investors will be talking about for years. But if they fail to convert that pipeline into actual recognized cash revenue, the burn rate accelerates the insolvency timeline, and the NASDAQ delisting becomes a near certainty. There is no middle ground here. The pipeline must convert to cash. So what is the final verdict on Datavault AI? This is a high-conviction growth story that is currently being strangled by a distressed capital structure. The underlying business is scaling at a rate we genuinely rarely see. A 443% revenue surge is extraordinary on its face. But management has funded this expansion through massive equity dilution, which is artificially suppressing the share price and punishing early investors. Execution risk remains extreme until that top-line growth finally translates into bottom-line survival. DVLT has shown us the contracts. They have shown us the pipeline. Now they have to show us the cash. If they do, this could be the comeback story of 2026. If they don't, it is a cautionary tale about burning too bright, too fast, with borrowed fuel. Now, I want to hear from you, and I genuinely mean this question seriously, because the community debate on this one has been unlike anything I've seen in a while. Do you believe a micro-cap company with an $800 million pipeline but only $2.2 million in cash at quarter end can realistically avoid NASDAQ delisting and hit $200 million in revenue by year end? Drop your honest answer in the comments below. Bulls and bears both welcome. I want the full spectrum. I read every single one, and I want to see what the Smart Stock Sam community thinks. If this breakdown gave you value today, smash that like button. It genuinely helps this channel get seen by more investors just like you. Subscribe if you haven't already, because we drop deep dives like this one regularly, and you do not want to miss the follow-up when Q2 earnings land. And if you really want to support the work we are doing here, you can send a super thanks using YouTube's support feature right below this video. Every contribution goes directly into producing better research and better content for this community. I'm Sam. Stay sharp, stay disciplined, and I'll see you in the next one.